Hello, everybody, and welcome to the Trading with Ashley show. This is me and Sadie Girl speaking to you today. We are talking all about Meta. Now, I have received a lot of questions about Meta, not only from my community members, but from those of you on YouTube. So we're going to talk about some potential trade setups. Now, I have found 3 potential trade setups for you, and they range. Of course, there's a risk to reward dynamic here, but they range all the way from about 20% annualized return up to over a 300% annualized return. But there's no free lunch. The ones that are stronger in their annualized return, they are riskier. So I'm going to take you through all of the potential trade setups so you can decide for yourself if this is a trade that you might be interested in. And I'm also going to take you through the technical analysis on Meta as I see it. It may have found its bottom, but there's something very interesting if you look at the charts. I'm going to take you through it that shows me it could go down further. And so if you are going to be interested in purchasing something like a skits or a leaps on it, you may consider doing that now, or you may just wait to see if we hit this other level that I see in the charts. All right, let's go into the computer and I'm going to show you what I am seeing on Meta and give you some potential opportunities. We have Meta pulled up, so as usual, the first thing I want to do is look at the analysis tab to get a better sense for the profitability of this company. So if you look at it, you can see they definitely are profitable, although they struggled on the most recent earnings, and you can see that right here visually. Lots of revenue, but they must find a way to turn all this revenue into more bottom line income. So that's the big issue right here. The fact that they're bringing in plenty of money, they're just not keeping as much. And this is because of what they're trying to do with being able to get into the data center dynamic, and that has yet to play out. And it's very expensive as you're expanding your business. And so we may see this for a few more quarters. So we may have some sideways chop consolidation action until Meta decides to take off. But let's go look at the details on technical analysis so that we can make the best decisions. From a technical standpoint, this is almost textbook what you would be looking for when you want to trade a stock. Now let's break it down so I can go through all the different components. The first thing that I want to talk about is this RSI right here. It's the Relative Strength Index. And most of you know from being with me for quite some time that anytime a major stock that's profitable is on sale, this is when the RSI is 30 or below. This means that this stock is oversold. So that's my first clue that this would be a very value opportunity for Meta. The other thing is where we are trading at the bottom of the Bollinger Band, but not just at the bottom of the Bollinger Band because these bands stretch. But look, we are below the 200-day moving average. So typically, if you have a long-term thesis on a stock, if you acquire that stock under the 200-day moving average, usually over time, in this case, maybe about 12 months from now, you do really well. The issue is we don't know if this is the bottom. And I guess you never really know, but you can have clues as to if you've hit the bottom based on how it behaves over the next several weeks. And so if we go another 3 or 4 weeks and Meta is trading sideways, right between this range here and maybe this range here, then that shows you that it has found its local bottom. But you may be excited and want to get in now. Well, that's okay if you have the ability to, and if you have the budget to, and if you don't mind withstanding a little bit more drawdown until this entire thesis plays out. You might want to start dollar cost averaging into the stock now, and if it pulls back further, you can add additional shares to lower your average. So the reason I say we don't know if it's the bottom, I want to show you something that I noticed. And if you are going to open up any trades that are in the riskier nature, and I'm going to go through some of those with you, I want you to be aware of this gap that I'm about to show you. If you go back to April of this year, that's when we had the tariff liberation day and all that fun. Meta created a gap, much like many stocks. So you see this gap right here. And this has yet to be filled. And if we get close enough, you would think that it would get filled. It kind of acts as a magnet of sorts. And where does that put us? If this gap is filled, then that puts us right there around that 560 area. Now, it's usually not doomsday. If it hits that, usually once a gap is filled, then we're back off to the races. And so if you want to anchor yourself to something around this 580 area, 560 area, that might be a potential trade. And if you're going to go further out, if this gap ends up getting hit here in the next couple of months, then it might bounce and you might be good to go. But that's just something to consider. It doesn't have to get filled, but it is there, and I did want to bring your attention to it. First trade setup that I want to look at is a sold put on Meta. Now, of all the different trades I'm going to show you, other than dollar cost averaging into the stock, this is considered a safer trade. Now, the reason I consider this the safest trade of all the ones I'm going to show you is the worst thing that could happen is you actually get put the shares. And then if you are put the shares, you just have to wait for Meta to recover, which eventually it will, and then you can start enjoying the stock appreciation that comes with it. But when you're selling a put, you want to look at an important level of support. So we're going to focus right here on that $600 level. It's a very important psychological level for the stock. And you can see right here on an option chain, this is for December the 19th at the $600 level. Look at all of the open interest right here. That's 14,000, and it far supersedes everything around it, showing you this $600 level is a very important critical level for Meta. Now let's take a look at our deltas. If you want to be put the shares of a stock, but you just want a value price on it, then typically you will look for something around a 0.3 delta. If you want to take a more conservative trade, now you may not have as good of a chance of getting the stock put to you, but a more conservative trade would be focusing on a delta of around 0.2. But if we're going with this one right here, the $600, you would be paid quite a bit of money to actually put up $60,000 to take this trade. In fact, you'd be paid about $1,330 to put up $60,000 to take the trade. Now, if you are trading on margin, it takes a fraction of the $60,000, so that would be a better risk to reward scenario. And if you're put the shares, you just have to hold them and wait for a potential recovery. After all, if we hit what some analysts are saying $1,000 within the next year, you'd be getting this for a significant discount. So that's your easiest trade right there. It is the $600 strike, $12.19, and you would receive about $1,300 for it. That particular trade gives you a little bit over a 20% annualized return. Not incredibly great, but if we get away from that strike really quickly, you can get out of the trade at 50%, and that may increase your return percentage because you're churning through the money quicker. Now, this next trade I'm going to go over with you is a put credit spread, and it offers a far greater return, but it is more of a risk. It's going to be the same day, but we are going to start off at the 580 area. And the reason I say that it is more of a risk is you did notice that that gap fill was at 560. And so you do want to watch this, and if it works against you, then you may want to go ahead and just get out of it and take a loss versus having a complete loss if it fills that gap. But here's the trade. You go out to 12/19/2025. You sell the 580 put and you purchase the 560 put. This dynamic right here, it's going to require $2,000 to put on the trade. That's because when you take 580 minus 560, that equals 20. You multiply that by 100, and there's your $2,000 that it requires to put on this trade. What will you be paid? Well, it's paying right now about $3.20 a share. So you would receive $320 in the next month, and you would require $2,000 to put on the trade. So here it is on a ticket. Now you see the $3.20 here. The reason it's only showing you that the risk is $16.80 is you are receiving this premium in advance, and you keep this regardless. And so if you put this trade on, it is going to give you over 170% annualized return, which is really good, but it is a riskier trade. So you just need to be prepared for that. Now, if it works against you, then you could always break these two trades apart. You could cash in on the purchased put that would have gained significant value, but then you would have to roll down and out the sold put. Now, if you were going to do that, you would need the cash, $58,000, to support this trade right here if you cash in and close out the purchased put. Of course, you would be rolling this down and further out, so that would require a little bit less premium, but that is one way you could do it. But for somebody with a smaller account, this would not be feasible. This next trade I'm going to show you, it actually combines a put credit spread with a call credit spread. Now, because you're combining the two, it still only takes $2,000 to put the trade on, but you will be receiving more premium because you're doing both sides of the trade. Therefore, this is going to give you over a 300% annualized return. So let's look at the setup. Here's the first end of the trade. It's the put credit spread. We just went through that together. But then if you decide to sell a call at 7:05 and then purchase a call at 7:25, that's going to give you additional credits. So you can see right here that the credit on this trade is $5.55 a share. So that's going to give you $555. And because you're getting more, it actually makes this trade less risky because you're getting more up front. But now, instead of just worrying about one side of the trade being breached, you have to worry about both sides of the trade being breached. However, it is unlikely that Meta would pull above 700 in this short time frame. So that is something to consider. If you do see that one side or the other is going to be breached, you may shut down one side of the trade and then let the other side work out to expiration. And that may make it a little bit less risky. But for this trade to remain 100% in profit for you, where you keep the entire $5.55 a share, then Meta has to settle in on your expiration date between your sold put 580 and your sold call 705. If Meta stays in between those two strikes, then you win 100% of this trade. Okay, everybody, I hope that gave you a few ideas and you can decide if this is a risk you're willing to take. For those of you that are interested in my $50,000 challenge, I've heard from a lot of you and you want to get in. I am taking applications for that. You do have to sign up for a brief call. We'll do a quick interview and find out if you're a fit for the program. I just started week 2 of the $50,000 challenge, so we still have several more trades yet to go. If that's something you're interested in, click the link below and then you can sign up for a brief call and then we can see if we can get you into the program. I'm going to leave a brief video that's going to take you through all of the various ways that I plan to trade in this $50,000 retirement challenge. I'm going to leave that video for you right here.